In this video, I'm going to show you exactly how a poor man's covered call trade unwinds if the market maker takes your shares. Now, here's the deal. You don't own shares, so how does that happen? There's two ways we close a poor man's covered call trade. One, where we control it. Two, the market maker controls it. One, we have control. Two, we don't have control. You're going to want to watch this video if you are going to use the poor man's covered call. That is absolutely a boot stomp. You need to know how the trade closes. But before we get there, I want you to go to my website, cptdashboard.com, because I have a free poor man's covered call tracker there. And you need to track your poor man covered call trades so you know when you're profitable, right? If you're going to purchase a leaps call option, then write near-term covered calls and potentially just use that for a premium collection or premium cash flow, well, you're going to want to know when you're profitable with your leaps option. So download the free poor man's covered call tracker in the description for all you lazy ones. Just click the button, go straight to free spreadsheets, grab your copy, download it, use it. Now, let's talk about this poor man's covered call trade, because here's the deal. We're talking Chevron. I let my members know that I was going to do a poor man's covered call on Chevron, and when I did the trade, they got the trade alert, and guess what? Chevron rockets past my strike price, and we have to take action. We have to take action because Chevron has an ex-dividend coming, and it's fat. Wall Street's going to want to come in and take it, and quite frankly, they're going to take my shares. Shares I don't have, so the poor man's covered call trade has to be unwound, and I could either do it myself or have the market maker do it. But you'll notice the numbers will look a little different, okay? So with that said, we're talking how a poor man's covered call trade unwinds when the market maker takes your shares. Now look, if you want to be a part of the membership, for which I talk to the members via video. That's right, I do little trade videos that you don't see here on YouTube. They are trade alerts, usually a trade I'm about to do. Hey, if I'm doing the legwork, I'm probably going to do it. Well, you get the trade alert, and I'll tell you what, you can read the trade alert in your email, or you watch it in your very own phone app. Yeah, with the membership comes a phone app. You get to see everything from all of my real-time trades. Oh, by the way, I let you know when the upgraded CTP dashboard is uploaded. And of course, you get to see all of my trades in and out, knocking it down. Go to cptdashboard.com, click upgraded dashboard. I give you one free month, and I would love to welcome you aboard. Hey, look, before I introduce you to him, what I want you to do is subscribe to the channel if you like anything you hear today. And hey, look, if you like this video, bang that like button. It lets me know you like what I'm doing. And what we're doing is this. We're handing it over to him as he talks to the members about this poor man's covered call trade and how he's going to negotiate whether he closes the trade, having control, or the market maker closes it. He doesn't have control. And let me give you a little spoiler. If the market maker closes this trade, hey, welcome back, everyone. It is time for another poor man's covered call. Let's make a decision time. What I want to talk to you today is about my Chevron poor man's covered call, for which the stock has absolutely blown past my strike price. If you remember, I did this trade back 15 days ago, and what we find with this trade is Chevron moved exactly where we thought it would. At the time, the shares were trading at $153. I picked the 155 strike, getting about $4.20. Now, I did that on 10 leaps call options. If you remember, bought those 10 leaps call options. I paid $54.53 using the 100 strike. And if you remember, the 100 strike, I believe, was the 95 to 96 delta. We'll bring it up right here. In fact, it's the 97 delta. So here is the initial trade setup inside of the poor man's covered call tracker. So when I plugged in these numbers, I was looking at the time value cost of this trade. If I buy the right but not the obligation to take somebody's shares at 100, pay 54.35 for it, I was only going to pay 50 cents in time value. So now the question is, can I make my money back on the first covered call trade? And of course, when I pick the 55 strike, which is about $1.50 out of the money in the moment, I was absolutely going to make $5.31. Chevron pops, and it has not looked back. So now the question is, and this is what I want you to take away from today's video. We have to manage the trade, or we're going to get slapped with a short sale. And what I mean by that is this. A lot of people don't quite understand how a poor man's covered call is unraveled at the market maker level. We always talk about being in control, meaning I can buy back my current option and spend money. Then I could sell my leaps option, making money. What happens if the market maker dips in and absolutely sends me my strike price, which is in this case 155 per share, times the number of shares, that would be 1,000. They would deposit 155,000 into my account. But what they do at that moment, let's take a little snapshot. Right now, Chevron's trading at 162.93. At this moment, they will slap me with a short sell of the stock at 155, which basically, from the market maker's perspective, gives me the correct debit. See, I was paid 155 times 1,000, but see, I don't have the shares. And my brokerage is not going to dip in and sell my leaps call option to pay for the shares, because somebody's paying me 155 for shares I don't have. So how does the market maker unravel this? And it's simple when we think about it. They will send me the $155,000. Now, I don't have shares. So the only way the market maker can make this even is slapping me with a short sale of the stock, which is a debit. They get their money. So I get $155,000 credited, but right now, with Chevron trading at 162.93, I will be debited $162,775. How do I clear the debit? And this is what I want you to learn today. It's the leaps call option. See, the key to this trade is the leaps call option has moved. When the stock was trading at 153.85, the leaps call option that I purchased was trading for 54.53. Because it's the 95 delta leap, right? It's the 100 strike price. I paid 54.53. That strike price had a delta of in the money, deep in the money, 97. Now, what does that mean? In this case, it means for every $1 the stock moves, for the most part, my leaps will move 97% of that $1 move, give or take. Okay, it's not a perfect science because as stocks move higher, the strike price deltas change as well. But for the most part, this is how it works. And if we take a look at where we're at right now, this is a snapshot right now. If the market maker dips in and takes my shares, which is likely, Chevron has a dividend coming, and the call buyer paid me $4.20 for the right to take my shares at 155, you could bet damn sure they're going to dip in, take my shares at 155 so they can collect the dividend. So if I'm going to manage this trade, then what I'm going to do is buy back my near-term covered call, for which I'm going to pay money. Then I'm going to sell my leaps call option, making money. But what if the market maker slips in and snags my shares I don't have? This is how it plays out. I will be paid $155,000. They will then slap me with a short sale. The stock's trading at about 162x. They slap me with a short sale at my 155 strike price. See, I can't make any more than 155 on this trade. So the market maker has to hit me with that short sale at 185. So I have to pay the debit. Okay, so now I pay the $162,000. That clears the short sale. Well, I was paid 155, I paid 162. There's a debit in my account. How do we replenish this trade with a positive result? We sell the leaps call option. And this is how this would play out. If I went ahead and let the market maker take my shares, I would get 155,000. The market maker slaps me with a short sale at the 155 strike. I would then lose 162,000. That's a debit of $7,700. Now, how do I clear that debit of $7,700? I then reach in and sell my Leaps call option. And in this case, I paid $54,053. I would collect $63,250. Because I did not have to buy back my near-term covered call, I collect all of that $4,200 premium. So guess what? When we add all of these together, we add the $4,200 in the covered call premium, we add the $8,700 in Leaps call option profits, and we deduct the $7,700 from the short sale, we sit with a tidy profit of $5,100, and that's a 9.44% cash on cash percentage gain. Now, hypothetically, in most cases, this goes to expiration. This is an August 25th expiration. It's still July 31st. We have time. We have time to let this percolate, but the market maker is going to take my shares I don't have. This is how this trade will play out the night before the X date. Why I say that with such confidence is because the stock has moved some $9+. So the call buyer, the guy who paid me $4.20 to take my shares at 155, makes money right now. They're going to make money on the 155. They're going to collect the $1.50 dividend, and then it's likely they're going to sell the shares the very next day. So my shares are going to be taken away prior to the X date. Now, the question is, how do I handle it? I can let that happen and let this trade go until the X date, or I can slip in and manage this trade. Now what I want you to do is look at the numbers once I plug in the near-term cover call buyback. Say I want to use from now until the X date, that time, right? Say the X date doesn't come out till August 20th. That is literally 21 days this money is sitting here making pretty much 2%. I'm going to show you why it's 2%. See, if I have my shares taken away prior to the X date, which is going to happen, I make 9.44%. We know this. Now let's do a buyback. The buyback is going to cost me approximately $9.35. So where I was paid $4,200, I'm now losing money. I'm now paying out much more. And you can see the debit, $5,100. But now we have to look at that Leaps call option. Remember, I paid $54.53 for it. It's now trading for approximately $63.50. And when we do that, look at what happens. We lose money on the near-term covered call, but we make almost $9,000 on the Leaps call option. Hey, these are hard numbers. I paid $9.35. That near-term covered call is closed. I now have a debit. How do I get it back? I sell the Leaps call option for $63.50. And there is my 7% cash on cash return for this investment. Here's the deal. This trade, if the X date is on August 20th, I now have from July 31st, which is today, until August 20th to try to find another trade that will essentially pocket me $2,000, right? That's about 2%. With about $58,000, remember, I end up making about $4,000 on this trade, I can go ahead and place a near-term 30-day or even 45-day covered call, making back that $2,000 and then making a little bit more. I'll tell you what, it's a decision I might make today. I wanted to show you how a poor man's covered call closes when I have control or when the market maker has control. See, a lot of people don't know when the market maker takes control, takes your shares, they're going to credit your account, but then they're going to slap you with a short sale, debiting your account. Then you have to sell the Leaps call option to make your profit. What am I going to do? I don't know. I'm going to think about it today. Chevron's up $4.40. At this point, I'm not making much more on this trade because the option has tons of real value in it. there's not much time value in that option anymore. So really it's a waiting game. When will the call buyer slip in, grab my shares, and close the trade? Well, I know it's going to happen before the X date because they are profitable and they want that $1.50 dividend. So with that said, this trade will close early. Do I close it early and use the time to my advantage, or do I let it go to the X date and get paid and make 9.4%? That is the question. It's that 2.4% that I'm losing if I buy back the option and sell the leaps. In return, I get almost 21 days to work with. Remember, time is money. I'm going to leave it right there. Be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.